Hello and welcome to this Markets Today special. I'm Udayan Mukherjee, and joining me is Sandeep Tandon, founder and chief investment officer of Quant Mutual Fund, which has over the last few years become one of the most successful mutual fund houses in the country. Sandeep, great to see you again. I want to ask you about this tweak which happened recently from the finance ministry, where they changed the rules of the game in terms of debt fund taxation. You were about at Quant to launch a very innovative product which could switch between equity and debt 100%, depending on how you felt about the market. Did that derail your plans and of what could have been a very interesting product for investors?
So frankly speaking, yes, it could have been a very interesting product because we were banking. We were not looking at the equity as a taxation. We were looking at debt as a taxation. But if anybody invests from 5 years perspective, 3 year perspective, that the differential between equity and debt taxation is very minor. Let's say 5 years is only points or 66 bips only. Okay, so it was unique in that sense. But when this got changed, basically the indexation benefit gone away. So we also have to make minor changes. So yes, it has reduced our flexibility up to a certain extent, not completely. We still have flexibility to take the equity exposure up to 100%, or we can make our equity exposure zero also, okay, by using the derivative routes. So that flexibility on the equity side remains as it is. But since we also opted for the equity taxation, and hence the flexibility on the debt side reduced to 35% only. So that one change which happened. So definitely is reduce the flexibility, but still the way we run it, we call it more active BAF for us, so it will be more actively or dynamically managed product than the industry, whatever they have been practicing so far.
Can you explain what you mean when you say that the flexibility has not gone away completely? I mean, how would you be different from a typical hybrid product which has to invest at least 65% in equity for the tax advantage?
So this also, since we also opted for the equity taxation, we also will be using that same thing. But see what happens in your how the SID requirement is up to 0 to 100 option is there. But a lot of people, because of taking equity advantage or equity taxation route, people tend to highlight that they will go up to 65, they will maintain 65%, and simultaneously they will, based on the risk of environment, they will try to do arbitrage. So they try to do true arbitrage all the time. Okay. Now, I have seen with our experience is that people tend to maintain some 30-35% exposure. This is, I'm talking about industry average, whatever we have seen, and people tend to hedge 30-35%. What we said, instead of doing the true arbitrage, we always have that option. Sometimes, let's say if markets are really bad and they're quoting at discount, okay, the true arbitrage can also give you some amount of losses because futures are quoting at discount and you are forced to do it. So we said that we have a flexibility, and we have talked about in our presentation that we can either use the options route or we can use the futures route, not necessarily stocks. We can use even the index futures also, okay? Because index futures are more liquid, okay? Whether you're talking about the bank nifty or the nifty itself, and maybe in future more indices, options in future will be available. So it gives you a flexibility to do that. And the flexibility, when we talk about, I'm talking about in terms of exposure. If we hedge 100% of the exposure, which we can do it, okay, even let's say we maintain 65% of the equity exposure, and if we want to hedge it completely, it will not take more than 25% of our capital to hedge the entire thing. So we still have that flexibility of hedging the entire portfolio. But yes, it caps the flexibility on the debt side, where we have to cap, because if I have to keep money for margins and M2M, then we have to, that the flexibility comes down only 35%. Whatever is left is 35%. So that's the way debt rolls reduces a bit. But the whole thesis around this product is that how well you can reduce the volatility of the overall portfolio. That typically happens with the equity exposure. If you can hedge your equity exposure, yes, you can still bring down the overall employed walls of the portfolio in a big way.
Let me ask this question in a different way, Sandeep. If you had full flexibility with such a product today, you don't now, and you could switch 100% between equity and debt, what would be your ideal exposure at this point in time after the recent rally that we had seen between equity and debt?
So if we have that flexibility, so I will explain it in a very simple manner, and with some examples, you will get a perspective. When we were looking at this product, initially we thought of lot of people who have FDS exposure and they don't want to come to the market because they're generally worried about the volatility. We thought of launching this product. We most of the time will keep the product, our the liquidity in the, or deployed our money in the debt segment. And appropriate time when we get extreme opportunity, we will come to the equity. Okay. So let's say example, when I say extreme example, March 2020 was the extreme situation. Okay. We could have deployed 100% in the equity market. September 2000, I'm giving example. September 2021, when risk appetite got changed, equity, or there was a euphoria in global equities and money flow at the global level was a lifetime high. That good time we could have hedged 100% our equity exposure, or we could have exited 100% equity. And come January, let's say talk about scenarios. So January 2023, okay, our risk profile, the risk appetite for Indian market and global market also started declining, though liquidity has started increasing. And right from January, if we were running this product, okay, we could have moved 100% towards debt. Okay, so that could be give you some perspective how we look at if we are in a today's position. Okay, because the way market has corrected very recently, some of the stocks were at very attractive level. When I attractive level, we don't look at just pure from the valuation number. We look at a much larger behavior perspective, try to see which are the stocks were in the neglected territory. Let's say pharmaceutical example. I'm giving you some examples so you can understand what we are trying to showcase. The pharmaceutical sector has been in now neglected territory. So some of the stocks we could have picked up in these names, and some of the large cap names also are also trading in the absolutely neglected territory. So some of these names we could have picked up. Okay, and we have also already picked up in some of these names in our portfolio now.
That's the past, and these are very useful examples, Sandeep. But what if you got 500 crores of inflow today and you had the same flexibility? How would you approach it now? Because markets have corrected on the way up significantly from the lows that you're talking about.
Yeah. So, see, Udayan, what happens now, if I have to look at the index level, in 5 years' time, 3 to 5 years' time, you get something like three such opportunities. But if I expand this logic to, let's say, BSE 200 stock or NSE 200 stocks, so in a year's time, you do get some 15 to 25 such opportunities in the market where some stocks, and I'm talking about the large caps name, I'm not talking about the small and mid and predominantly liquid name, because this product was meant from a risk averse perspective. You do get such opportunity. Okay. We have capitalized few such opportunity. Two of that opportunity we have already captured in our portfolio because we just started deploying money now because we just raised it on 12/13. So in last few trading sessions, two such opportunities we have it and we have deployed money. So it's a sometimes you do get. It's not like risk off, risk on can be environment from a broader market, but you do get sector rotation approach, you do get stock specific approaches also. So you could be a possibility that there could be a completely risk off phase in certain stocks. So those are the names which we can capitalize and which we have capitalized.
Okay. Now, for somebody who keeps an eye on risk so closely, what do you make of the India VIX right now? You know, May last year, I think it was at 26, 27. Now it's languishing at 12. Does it worry you as an investor or a fund manager that the India volatility levels have fallen to such low levels?
So then it's an interesting question. I will put this perspective. See, a lot of people have just started looking at VIX, and a lot of people look at VIX in isolation. Okay. The way we explain the phenomena is that overall derivative volumes have declined significantly. People, the market participant, have hardly any exposure left in the leverage market. In this background, the importance of leverage data also comes down significantly. Let's say give you some more example. Okay, when Bitcoin was in a right from 2015 onwards or 2012 onwards, we have seen some new animal which known as the cryptos came to the market. But if you look at in last 1 year particularly, okay, money flow towards crypto as an asset classes has come down significantly. And earlier we used to look at crypto data or the cryptocurrencies data as a risk appetite indicator for the young generation or for certain countries. Now, if overall volumes has come down significantly and hence this concept of risk appetite for young generation has been lost. So it's very important to understand the contribution it is making. Let's say one more example I'll give you, crude. Okay. Today is still very, very important, but the relevance of crude has declined over a period of last 10 years as compared to natural gas. And now maybe in future it will get declined further because the renewables are coming. So it's also very important to understand what role that particular asset classes or stock or sectors playing in the overall perspective. If overall volumes of the, let's say, in Indian derivative market has come down and his relevance is also declined, but low walls or sticky walls which VIX is showcasing right now, it also showcase some signs of vulnerability at some point in time. Okay, if some global events unfolds, okay, it has the probability that VIX can also spike. So we have to look at from both perspective. One, if just looking at the VIX, can you get all the answer? Answer is no, because the selling which happened in the market was predominantly the ETF-led selling. Okay, the passive fund selling which was there, and which has no impact on the VIX as or the derivative market as a whole. So that's the reason we can say the relevance of VIX has declined in today's context. But you cannot ignore it also completely. As I said, it's a low walls also means a sticky walls, and if some events unfold, it can spike significantly.
Mm. How are you characterizing this current up move in the market, Sandeep? I mean, does it strike you as a relief rally because people have become too pessimistic, or is this the start of a new trend?
So yes, people were very pessimistic. If you really look at a month back or last few months data, in generally people are tired, people have given up, there's hardly any interest. Even if you look at from the market momentum point of view, when you look at it has become a largely institution player versus real retail. So the in between the layers of the family office or ultra HNIs or HNI or real retail player who was participating in the market, their participation has gone down significantly. And then if you really if I have to quantify in terms of quant fear index, okay, it was in some of the stock it was as high as pre-COVID level, and in some of the names it has spiked, and that's the reason we have seen this sort of sharp recovery which is happening, because nobody wants to participate in this rally, and market was very light. So the impact cost, then if I have to put it statically, the impact cost in the market has gone up significantly. So market has fallen with low volume, and similarly market has rallied also with low volume, because the impact cost is very meaningful.
So, to come back to my question, are you still characterizing this as a relief rally, or do you think it can take the market back to that old high?
So if you really ask me the way, then we don't analyze in this manner. Yes, there could be some sort of pause. Maybe if this rally momentum continues, like a lot of people are looking at 17,800 as a important level. If it breaks, then 18,200. We don't look at the market in this manner. The way we manage our money is that any given time we play or try to generate alpha through sector rotation or stock rotation. Okay, because we are traditionally a long accounts mandate which we have. Because if you really ask me, yes, 2023, I have been talking about, this is the culmination of a volatility expansion phase. We have been talking about right from 2018 till 2023. This is the volatility expansion phase, which means the employed walls of the global asset class will remain elevated, and this is the peak year of that. And when we say this is the peak and the final year for that, typically the employed wall will spike further at the peak of the cycle. That's the reason we say that it can only spike with some event which can unfold. But you also keep in mind, if this is the culmination of that phase which is getting over, it means any dip which can come for any global event used to be buying opportunity, because Indian macros are far superior. I don't think in last 30 years of my career we have seen all good data points are there. So very compelling case for a long term investor. So we remain very constructive buy on dip strategy. We like to play through this route, and the sector rotation really help us. So we are not trying to time the market, trying to say whether this is a breakout zone or it can correct further. The way we are looking at, yes, we are still in risk of environment. Most important point which I want to bring to your knowledge is that we have been showcasing that in the fourth quarter of 2022, the tightening cycle, okay, a lot of people are still not willing to believe the tightening cycle has actually peaked out in in October, November of 2022, which means the liquidity, easy phase of liquidity has come back, and liquidity has hit some of the liquidity parameters which we look at globally on multiple asset classes or multiple countries was one of the lifetime lows, whatever data we have. So which means this is the new liquidity up move which is there, and it comes with a lag effect. It doesn't happen that the liquidity moves immediately and market will rally. Sometimes the lag can be few quarters also. So if I have to go with a historical some averages, I can expect maybe 2 quarters lag effect. Market should be in a sustained bull run, and that's the reason, based on some of the data points or through predictive analytics model, we have said that you will see all-time high as early as fourth quarter of 2023 calendar year or first half of 2024. Okay, that's the way we look at the market. If I combine the multiple data points, this what market is indicating that you will see. So now question comes, if we are also talking about volatility expansion, this is the peak year of volatility. Do we have any current event risk? Answer is yes. There could be high probability because this is what data points are endorsing. There could be event risk which is there, and I don't think that event risk is there in India. Is if there is a global event which unfold, let's say in the next 1 quarter or two, I will look for a buying opportunity rather than saying that even let's say there is a steep correction also. Because if events unfold, the corrections are very steep and very sharp, but it lasts for a few days. So I will look for a buying opportunity. The entire thesis for India buy on dips, because if I have next 6 months perspective or next 6 years perspective, I think India still looks very appealing given where global markets are. Maybe possibility is that the risk appetite data, which is right now is on declining side, maybe in next 2 years or next 2 months or 3 months or maybe a quarter or two will come back. So that could be again a good combination when risk appetite comes back and liquidity is anyways on a higher side. That could be a good indication that one should can be all in, even in small names and small cap and mid caps also.
You spoke about sector rotation just now, Sandeep. I want to ask you about IT because that's a sector where there is a lot of pessimism following the Infosys results recently. But what are your internal indications or parameters saying about the CNX IT index?
So let's talk about some of the extreme scenarios. I'll give you some perspective. When we spotted that global euphoria in September, October 2021, that was a very classic case globally, not only in India. If you dissect the euphoria which was there globally, it was predominantly new age companies and technology and the growth stocks, and technology in particularly. So if you ask me, that is the very classic top, not necessary in terms of prices or the value or in terms of earnings. What we have said that 2021, I have made a very bold call saying that this could be a decade top from a valuation multiple. Neither we are talking about price nor we are talking about the earnings. Earnings can move up, prices also can move up. The valuation which we have seen, I don't think for next 8-10 years you will see, at least in this decade, that's that sort of valuation which we've seen. So that was the very classic euphoria, and we call it as the sector was trading in the most admired. Okay. It's a very interesting way we look at some of the market, like when you talk about, and I'm linking with this example to showcase how the importance of timing is there. When we all talk about in our portfolio that 20% stock gives you 80% returns. Okay. And same logic can be extended. Only 20% times stocks gives you 80% return. That's the way if you extend that thesis. Okay. So it is that classic situation was there in September 2020. When now, if you ask me from extreme euphoria, where are we? So no moves are linear. In between, we also have capitalized. We also use this opportunity to participate. My view is that we have yet to see the neglected zone. Like ITC was a neglected zone in September 2021. Banking sector was a neglected zone. The pharma is a neglected zone right now. Whether ITSI index or ITSI stock have reached there than those neglected zone, answer is big no. Maybe one or two stocks are approaching those zones. So maybe one can look for that opportunity. But broadly as a sector, I think still it will take some more time. We'll consolidate it. If not very steep fall from this level, I think time-wise correction is still pending in this sector.
Sandeep, good to hear your thoughts as always. Thank you very much for your time today.
Thanks, Udayan.
Thank you. Bye-bye.
If you like the video, do like, comment, share and subscribe.